Hey everyone, Ben Nelson, the everyday real estate investor here. Hope you're having a fantastic day. I am super excited to have another awesome guest here today. We're going to talk about uh, investing, of course. We're going to talk about a little bit about syndication. We're going to talk about the economy, and we're going to see what else comes up. So we have Sep Bekam Investment Group here today. Seth, thanks for being on. We've been trying to get this going for a while. I appreciate you being here. I know you're busy, and thanks for being on the show.
Thank you, Ben. Yeah, pleasure to be here, and thank you for having me on your show.
Absolutely. Well, just so people can get to know you, why don't you share just a quick version of who you are, what you're doing, how you started, just a quick rundown so we can get a glimpse of of who you are and what you've done.
Okay. Yeah. Well, I had my background is as a electrical engineer. I went to school, got into the rat race, and I expected it to be a lot of fun, but it was miserable when I got into the workforce. Got laid off from my first two jobs. Didn't like not having income coming in when I still had expenses. So I thought that for real estate investing, you need a lot of money, you need a lot of credit. I didn't think that it was something that you could, just get creative with. You could syndicate, you could do all these other cool concepts, creative financing or wholesaling and all that. So I didn't I wanted to find ways to have more passive income or more income coming in, I should say. And my only solution was, okay, go and get more education from school. So I was going for my master's degree, and then I got burnt out. I was working a full-time engineering job, 40 hours a week, 2 hours a day in traffic, and then going for my master's. And just by chance, a friend had noticed I was getting burnt out and introduced me to the concepts of purchasing power, inflation. And she just asked me, "Is like, why are you trading your time for money when the government just keeps printing more and more of it?" So like it was a very it was just like the movie from the Matrix where Neo is presented with the blue pill and the red pill, right? So that was kind of my red pill moment, if you will. Is like, okay, I don't want to go down this path where I'm in the mercy of my job, mercy of the economy, mercy of the paycheck, and I'm just basically a slave to my wages. I want to be financially control of my future and financial control of my life. And she introduced me to this book by Robert Kiyosaki called Conspiracy of the Rich and changed my life. It just basically explained how you don't need to have an MBA, you don't need to have a like an entrepreneurial like bone, if you will. Like you can learn it and it's teachable, and you get involved with businesses, investing, passive investing, and you can get into these things called hedges where you can hedge against inflation. And that was back in 2010, and I've been doing it full time since 2014.
That's awesome, and there is so much there. Number one, I have not read that book by Robert Kiyosaki, so I'm going to have to check that one out. Read a lot of his books, but not that one. Number two, it's just always amazing how the stuff that is the most important to learn is the stuff you have to almost dig. Well, not anymore because it's all out there if you want to find it. Um, but it's not put in front of you like our standard education is,
Right.
right? It's still, we're still in the system of here's how you do it. You get your degree, you go get a job, and if you're not making enough, you go get another degree, right? And then hopefully that's enough for you to get you where you want. And this self education, this different way of doing things, it's considered non-traditional, but it's like this is what the rich do, right?
Right. Yeah, the wealthiest people I've ever known, they're curious, they're constantly learning. And I don't know who said this. It might have been Jim Rohn or someone else. I didn't come up with it, but so there's two types of people in the world. There's know-it-alls and there's learn-it-alls. And the very affluent people that I've met, family offices, credit investors or whatever it be, fund managers, they're curious, they're always learning. You don't hear them say things like, "I went to school and I already know everything." And the least
Right.
successful people that I've met, that's what they say. Like they just stop learning as soon as they get the degree. And it's kind of ironic because you go to college because you think it's supposed to make you smarter and more successful, but for a lot of people it kind of shuts them off to new ideas and new opportunities.
Yeah, yeah, it kind of puts you in your puts your blinders on almost, right? And you
Right.
can't see anything else. So it's like, hey, I'm educated, so I know.
And I'm guilty of that.
Okay.
Yeah.
Yeah,
because I
I
didn't have
think
the
we all are to some degree, right?
yeah,
Yeah,
I wasn't into books or personal development until I realized that the more we focus on ourselves, and that sounds kind of selfish, the more we focus on improving ourselves, we can, we'll be financially better off. And taking a step further, the more we can improve other people's lives, then the mutually beneficial it is. They can be better off, we
yeah,
can be better off.
absolutely, absolutely. That whole abundance and bringing people along with you, and not, I think people think, oh, rich people are selfish, right? When really that's not the case for the majority. I think.
I agree.
Yeah, it's really about you help, and we all know the quote, or we should, Zig Ziglar, right? If you help, you can have everything you want in life if you just help enough other people get what they want. And that's, I think, the mindset of most that are successful in this world. So um, let's talk about got your background a little bit. Obviously, you're investing. I'm going to go back to one of your first deals. I'm going to go back to it right now, and I've heard the story a couple times, but I want people to hear it because there's a lot of, I think, lessons and a lot of just a lot of benefit people can get from hearing it. So tell me about. So you were in the apartment space. You had done a couple deals. You took the next step up to involving other investors, right? Syndication, bringing some funds together from multiple parties, and you're buying an apartment building that you're gonna do a value add on it, right? Um, you know which one I'm talking about.
Yeah.
So tell me about that one. And uh, again, as much or as little as you want to share, but you had some ups and downs on that one for sure. So I'll let you tell the story.
Yeah, that deal took years off of my life. So a lot of the books and the trainings, and I'm still going through trainings today. Like I'm still involved in masterminds. I have mentors and coaches, but and I see that as being very helpful. But earlier on, you don't know what you don't know, right? So when I was working full time and investing part time on the side, I thought, okay, I just got to buy properties and buy properties like what the books are talking about, the real estate investing books and all that. Well, the books, like they're helpful as far as like getting you motivated to start, but there's no book that's going to put down all the possible scenarios of how a deal can succeed, and there's no book that's going to talk about all the scenarios about how the deal can fail. And a lot of the podcasts and a lot of I mean, nowadays, like YouTube videos, they like to talk about the grand slam deals and just everything goes right. My experience was very different. For years early on, it was like everything that could go wrong went wrong. And there was times I was like, I felt like giving up because I would be buying properties thinking, okay, well, the pro forma, the sheet that the real estate agent or the wholesaler provides showing the estimated returns, well, that shows that this apartment building is going to cash flow on day one, so we should be set. And then getting like a hard lesson after closing, realizing, okay, it's negative cash flow and I have to put money into the deal to cover the mortgage. It was uncomfortable. So the first couple deals, my philosophy starting out was I just wanted to buy real estate and have it be passive and have it be easy, and I'll just keep working my engineering job. I never thought I would be doing it full time. As soon as I did, I thought it would be like 40 years and just buying one property per year. And what happened is I accidentally started buying properties in the hood. I was buying on the wrong side of town, or the more economically challenged parts of the areas, and I would go and visit the properties. Like all the first like 5 years of investing, I'd go see every single property before I bought it. Like, this is fine. Like, I don't need a bulletproof vest, and I don't see like you don't see like drug dealers or gangbangers and prostitutes on the streets. And I didn't realize later that it's at nighttime that you start seeing that type of stuff. So I go during the day. And it's the common story that you hear from a lot of investors who invest in like C class or D class areas is they talk about the horror story and they say, "Oh my gosh, I lost a lot of money and I sold and I ran." Like that, well, that's not really helpful when you're in a deal, especially if the deal is personally guaranteed. So that one particular deal you referenced, it was apartment complex in San Antonio, Texas. It was 58 units, and I did have investors that I brought into it. So I was the syndicator, and the investors were going to be passively investing into it. So we already owned a property down the street, a sixplex, and we were slowly, turning over the units. And the way the 52 unit came about was the real estate agent who helped us purchase the sixplex said, "Hey, Sep, there's a seller up the street, and they're really motivated. And it's a bigger property, but I think you might be interested in it. I said, okay, let's go check it out. And I thought it was going to be like a 4 unit or 8 unit. And we go, and then we're driving, and there's a building on the right side of the street, and I look on the left, there's a building on the other side, 22 unit and a 30 unit, and there were like security bars against on all the windows. It was old paint, just dilapidated, and it looked like something from like a haunted movie, right? It was an eyesore, and it's ironic because the community, like just a couple blocks to the left, you have mansions. A couple blocks to the right, you have flippers. So it was the ugly duckling in a good community. Well,
Which is what you typically look for, right?
right. And
Yeah.
if it's a house, it's easier to change that ugly duckling into a swan, right? It's one property, you have one tenant, but if you're dealing with an apartment complex, it's like having 52 different tenants that you have to worry about. And one of the challenges was we didn't know who the tenants were. Like we didn't choose the tenants. Our property manager didn't choose the tenants, so we inherited them. And I thought, okay, we'd be able to cash flow. And it went a couple of years with no cash flow, but that was the least of the challenges. That deal, we went through one, two, three, four, I think 5 or 6 property management companies. I had 2 property management companies that I had to let go, and I had 2 property management companies that fired me as a client. And again, that's not something that the books
Wow.
talk about. But when a property manager fires you as an investor, there's 2 things. A, you're not the A client that you think you are as an investor, and B, they don't let go of the client when everything's going good. They let go of the property when it's like, okay, this is serious, this is a huge liability. We're just going to cut our losses and leave. So
Yeah.
it wasn't until after after closing that all the drama started happening. And we're talking, we found afterwards that we actually had prostitutes in that property. We had gangs, we had drug dealers, we had criminals, we had convicts, we had convicts on the run. We had thieves stealing from other units, and there were drive-by shootings. And the police were familiar with that property. So
Yeah. And one of the things I'll just interject here that you had mentioned about it's a lot easier to turn over a single family home, right? If you have a single family home in an area that's transitioning, or that it's the bad home on the block or whatever, um, getting one tenant out and then now you've replaced them, they are surrounded by good tenants. Well, you have a building where maybe the other buildings and the houses around it are decent, but how do you convince a good quality tenant to move into this building that has, like, how do you do that? How do you make that you eventually have to get better tenants in there, but how do you do that when all of your other tenants are this tough demographic, with all these issues of crime and everything?
right. And yeah, and that's something that doesn't get talked about enough, I don't think, because yeah, I mean, even there's some streets like in Memphis and Kansas City and Atlanta, and it's kind of street by street. You could have a beautiful high value neighborhood, and just one street over, there's a couple of houses with boarded up windows and kind of dilapidated, but it doesn't stop the people in the nicer part of it from living over there, right? But with an apartment complex, if a family is going there and they don't feel safe, they're not going to bring their kids over there. It doesn't matter where they are on the economic spectrum, right? They'll go live with
Yeah.
family. They'll go live in a car if they have to. That's better than getting bullets coming in through the windows. And with the other challenge, I mean, with repositioning the complex, repositioning meaning not just renovating, but changing the operations, changing the management, improving it, improving the community, and improving just the business operation, if you will, to have it go from like eyesore to desirable. That takes time, and it also takes the right team. One of my mentors said, and this kind of this one phrase would summarize the transition for that property. Is when I learned from a mentor, he said, Sep, you can't have a Beverly Hills property manager managing a Walmart property. You want to have Beverly Hills property manager managing Beverly Hills properties, Walmart property manager managing Walmart properties, and Target managing Target properties, right? Because each of those, the person who shops at Walmart generally doesn't shop at Nordstrom, and someone who's,
Yeah.
you know, uh, shops at
Yeah,
Nordstrom.
they require different levels of attention and different types of procedures and all of that stuff,
Right,
right?
exactly. So
Yep.
yeah, that was the paradigm shift. And when we finally got a good team in place, everything turned around. It took a couple of years, but they were able to get it turned around quickly. And we saw the crime decrease 95%. We saw it going from being like hard to get people to come in to actually having a wait list. So we ended up selling that
That
one
is
off.
quite the transition.
Yeah.
Yeah.
And that was what was more gratifying. I mean, yes, we made a lot of money on the property, but just you could go on the Google Maps and you could see the transition of the property over time, like the Google Street View, and that makes it worth it because it's not just like we're going in and making things more expensive. We're going in and actually removing a cancer from the neighborhood and making it so it's clean, safe, and affordable.
Yeah, absolutely. Absolutely. Yeah. And again, that's where it's tough in cities where you feel like landlords are looked down upon because that's the part they don't see is that there are and there's good and bad landlords just like there's good like in anything, right? But um a lot of people out there are doing what you're doing and trying to make it better for the residents in the community, and they're not just getting going in there and trying to gouge everybody, right? So um yeah, that's a great, I mean, you're making the community better, you're making the property better, you're making it a safe place for everybody. And yes, you're displacing some people, but you could argue that they displaced themselves with their choices. So
Yeah,
awesome. Well, I appreciate you sharing that. Yeah, the big thing that I wanted to get at is, and you mentioned it kind of in this, is that you know yeah, you could just cut bait and say this isn't working out, and investors lose money, or you lose money or whatever, and you just okay, I'm done, and take it even a step further and be like, this isn't working. I can't do real estate. I'm not going to do this anymore. And so many people do that from one bad experience instead of trying to figure out what steps to take to get through it. There's a lot to investing in real estate, and until you start getting your hands dirty, and to your point, maybe having a mentor to help you along with that, right? To help you from some of those pitfalls. But that's how you learn.
right.
And you're not going to run into any challenges until you start investing, and that's when you run into those challenges, and you have to figure out how to get through them.
Yeah, and that's where a lot of the breakthroughs can happen too. Ryan Moran has a good saying. He says that capitalists innovate to solve problems, and I like to take that a step further. I like to like just learning from reading the real estate investing books, the economics books, the business books. I've and just spending a lot of time with other investors. I like to say that capitalism is about solving problems because if you think about it, like the markets, like that property was in San Antonio. There was no rent control over there. We didn't have to we didn't have to go through some bureaucratic agency to get a gangbanger out of the property. Like it was more like laissez-faire to an extent. I mean, it did take a little bit longer than I would have liked to get evictions out, but if that was in California, it could have taken over a year to get some of those evictions done. And I feel sympathetic for any of the investors doing that in the states where it's a lot harder, like anti-capitalistic, anti-business, because it becomes less. There's less incentive, right? If you're to go in and take on all those risks, to put all the capital into the deal, and then you can't get the rent upside or you can't get the equity upside on it. It's like, well, I'll just go elsewhere, go invest in a different market.
Exactly. Yeah, and I agree with you. I think that even if the intent is pure, so to speak, um, uh, the it doesn't work in the sense that like you said that well, why would I risk my capital, and why would I put all this time and effort into this if I'm not going to get returns on it, like it or not? That's how it works, because they're the ones taking the risk, and so they should get the reward. That's how our system is set up, and that's what provides incentive for people to build and produce and um, you know own buildings and new developments and all that stuff. So um, yeah, for
Right.
sure. It's and then to your point, you go buy somewhere else. You're in California. You don't own anything in California, do you? I mean, at least not most of your stuff is not there in California,
No.
if you have any.
Yeah, just my wife has two properties, but yeah, not. I mean, things would have to change significantly for. But it's funny, like a lot of investors I know in California, like they look at like investing one state out as a foreign country. Like they have to go and physically touch the property. And now we're at the point we got about 230 houses. Like I don't go and see the houses when we buy them. Instead, we have good teams on the ground, and they provide pictures. We use technology, so we can underwrite the deal better than me getting on a plane and me going and inspecting it myself, because I might not see things that an inspector would know to look for or contractor would look for. and
Yeah,
just kind of rather be geographically agnostic. And I mean, something Russell Gray says, he's like, capital flows where it's treated best. It's not treated well in California. It's not treated well in New York. It's treated well in other markets.
that's a great phrase. Yeah, I'm sure I probably heard him say that before, but yeah, that's a good one. Um, yeah, the that's a such a big mindset thing I think for people is so many people, whether it's by becoming accidental landlords or just choosing because it's closer, investing in your own backyard, your own market is just almost like that's what you're supposed to do. And that's where so many people start, and then thinking about investing outside of that is just they can't even comprehend how to do that. But the reality is that you're probably even holding yourself back on your investments in your local market because you shouldn't be doing that stuff anyway. That's
Right.
why you have a great team. To your point, you're not the best person to go out and inspect the property. The property inspector is, the property manager is going to look at it and figure all that stuff out. Well, what's the difference between if it's here or 1,000 miles away? There isn't one. You should be relying on your team to be your eyes and ears for you. Now you have to vet your team and make sure that they're a good team.
Right.
That you absolutely have to do. And I've not done that before, and that's how you learn hard lessons that way. But yeah, I mean, I have investments here locally, but I have a team that handles all of that stuff. I don't drive by them. I did it first just because it was fun, and then I stopped thinking about it because I didn't have to.
Yeah, and it gets to the point too. The amount of time you could spend on driving by and seeing the dealers yourself. I mean, that's time you could spend on talking to investors, talking to brokers, finding other deals too, right? Um,
Absolutely, yeah, and yeah, exactly. There's only so much time, and it's figuring out what are my high level tasks that only I can do. Um, and it's talking to investors, it's talking to brokers, people that talking to owners, uh, things to get you the deal, and put the deal together, not all the little nuances of underwriting in the sense of the property. Now you have to underwrite it,
right.
but you're not going to analyze how much is it going to take to fix this up and what are the rents going to be. You have to know those numbers too, but you have to rely on your team to put that together for you.
Absolutely.
Yeah. So before we got on the show here, you had mentioned, so we talked about how you did multifamily now, and you mentioned, which I didn't know, that you had made a shift to single family. So I am curious to hear what prompted that shift, and why you decided to go that direction, and just kind of get a little bit more from you on what's going on there. And are you fully away from the multifamily space now, or just kind of partially transitioned? So what does that look like for you,
Yeah,
and
well,
why?
well, first, I think I mean, it's supply and demand, right? So one of the lesson one in economics, right, is if there's if you have a shortage of supply, then demand is going to go up. You have higher prices. So the solution to the whole affordable housing crisis rather is we need more housing, we need more apartments, we need more mobile home parks, more houses. But I thought just going into it that okay, well, apartments are going to be easier to scale, and I thought that my passion was in multifamily. My passion is actually in affordable housing, and I learned that from Robert Helms's Goals Retreat, and just seeing like the experience with some of these multifamily properties, like if it's an A or B property and you don't have all the drama of like C class, then it's an easier experience on a multifamily, right? But if you're in a C class or D class multifamily property, it's a lot harder to reposition that when the bank is saying, well, it's great that you renovated 99 out of 100 units, but you have that one unit that caught on fire. So we're not going to give you a loan until it's 100% rehabbed, right? They generally want to have the building to be entirely functional and operational versus if it's 100 houses, you could have house number 63 that let's say if there was a fire over there or if there was an eviction, well, it doesn't affect any of the other houses, and that doesn't affect whether or not tenants would want to move into the other houses. So I like the fact that there was more exit strategies. And back to the point on inflation, I consider myself a collector of real estate, and most of the investors that I work with passively, the same thing. So kind of the secret weapon with single family is the ability to get a 30-year fixed mortgage. So we could do the renovation, we can provide the house to the tenant, and even with rates the way they are right now, I mean we have one loan that we're closing on at 7.5%. We have another one that's 9.2%. And some investors might say, oh, yeah, really high, right? But it's a single digit. And borrow a quote from Bob Helms, the godfather of real estate, Robert Helms' father. He said, he was investing in real estate for 7 or 8 different decades, and he said he's seen interest rates go all the way to double digit and be at single digit lows. He said any time that the interest rate is a single digit, take it. So it's relatively like
Love
high
it.
right now, right? But if the deal makes sense today, and you have a deal below replacement cost, you know that there's going to be a tenant over there, or that there's ARV in it, then you buy it once, you can go on and focus on the next one. Generally, inflation tends to be very good for rents, but it's not something I would wish upon my tenants. Like I wish there was no inflation, because it's just because it's good for us doesn't mean it's good. We benefit
Right.
from it because we're strategically positioned as real estate investors to do that. The ideal scenario would be that they preserve their purchasing power and we can keep housing permanently affordable, but we can't control the Federal Reserve or the government. So this is our way to adapt to it. So kind of all that culminating together is like looking at these as more inflation hedges and helping us solve that affordable housing problem.
Great. That's great. Yeah, and you still get, when you have a bunch of houses, you can still get some of the economies of scale with management and the fact that, okay, well, one vacancy, because that's one of the, well, if you have a house, it's either 100% occupied or 0% occupied. Well, yeah, that's true, but if you have 100 single family houses, it's still the same. It's basically like owning an apartment complex with 100 units. So one vacancy doesn't kill you. So that's great. Yeah, affordable housing. There's a lot of different ideas about what the solution is for that. But that's, yeah. We need. I agree that we need entrepreneurs in that space to tackle that problem. I think that's the solution. So that's awesome that your heart is in that and wanting to be in that, because hey, we need that. Um, so you mentioned the economy in general. So let's talk about that, because I talk a little bit on just some clips that I do on some of my prior podcasts about how, you know, and I want to get your take on this too. So should we invest now? Where's the economy headed? You had mentioned earlier, well, yeah, interest rates are higher, but they're still single digits. So, it still makes sense. So I really want to get your 2 cents on all of that, because my take is, um, you know, even if we're going to see some additional correction in prices, price is just one factor, right? And it only really, yeah, if you're going to try to, it's like trying to time the stock market, right? You're like, well, I'm going to wait till it's at the bottom. Okay, well, you know when that's going to be, because if you could tell everybody, then we'll all be happy and rich, right? But you don't know, and so you're just looking at one piece of it, um, and there's a lot of factors to be looking at other than just price and trying to time the market. So that's kind of my general like 20,000 foot view take on it, is don't sit out on the market. But not everybody feels that way. So, there is something to be said if you're really closely watching cycles, if you feel like we're in a certain part of the cycle, waiting maybe a little bit or something. So, what are your thoughts on that?
Yeah, and I agree with everything you just said. An analogy that comes to mind is one of my investors was got into Dogecoin. For any of those listening, I don't know when they're going to be listening to this, but Dogecoin was part of the whole crypto craze. It's still crypto is still a thing, right? But that particular coin, people were just throwing money at it and they were seeing wild returns, right? It was like tulip mania. It was like the 2007 with single
Yeah.
family, and
Yep.
just buying it because everyone else was buying it. And I would get screenshots from the investors showing, oh, it's going to the moon and 20% return in one day or 15% return another day. and and I was like, I was tempted. I was like, I kind of want to gamble on it, but it's like the fundamentals don't make sense. Like this isn't something essential to humanity. Like what is a Dogecoin? It's like, all right, you have a medium of exchange, let them have at it. But why is that growing so fast and having higher returns than gold in the similar time period? It just didn't make sense. But that's the time when most people get into investing, right? Is they want to see everyone else doing it and they want to get confirmation, and then they're like, okay, now it's a safe time. That's the worst time to get into any type of investing, right? The signs
That's a
were there,
great point.
yeah, for any
Yep.
asset class too, right? And that's where
Isn't it Warren Buffett that says when people are greedy, get scared. When people are scared, get greedy, or
right,
something like that. I don't think it's exactly that, but yeah, it's basically kind of do the opposite of what everybody else is doing, not the same
yeah,
thing.
and and the counter to that is being a contrarian, right? So Dave Zook, another investor that we know, successful syndicator, at one of his presentations at the syndication seminar, he had showed. I hope I don't butcher this. An investment that he made where it was basically a bunch of timber, like a huge amount of timber. And he got the idea because he read one of Jim Rogers' books. And Jim Rogers was the co-founder of the Quantum Fund with George Soros. And he's very different politically compared to
Okay.
George, but
Hmm.
they made a lot of money together. Jim is a contrarian, and he says when you make an investment, you want to only buy the investment, like only invest whatever it is that the product or service when it's just sitting there and you can just walk over and pick it up, and basically like easy, right? And that type of contrarian investing, and that's like investing in war zones. That's investing when after a company's stock had crashed or after like some type of commodity crash. So in Dave's case, he saw that.
Yeah, when there's high levels of supply, and think, yeah, that's interesting.
Right. And Dave
Yeah,
kind of took that and he bought a bunch of the timber at a steep
yeah,
discount, and he made like a 300% return in a pretty short amount of time. And the same thing could be in real estate investing too, right? Like if you have a view or a vision for an apartment complex or a house, whatever it be, different than where it's right now, there could be a lot of opportunity, right? Just making sure that there's a demand for it, that the market has demand for it. But especially if no one else sees it, that could be a gold mine.
absolutely. Yeah. So where's our economy headed? Huh?
I'm very pessimistic, and I subscribe to the Austrian school of economics. Most of us in high school and in college we have to take an economics course, right? But economics is like taking engineering. Well, what type of engineering? Petroleum, civil, mechanical, electrical, robotics. Like that's just a very general notion with it. So schools teach Keynesian, and Jim Rogers, Peter Schiff, um, Doug Casey, like a lot of those investors tend to be more, I'd say, way more pessimistic. So they talk a lot about national debt at $31 trillion. For that national debt, that's basically money that's not only the current Americans owe, but all of our future generations. And we look at the unfunded liabilities, and you're looking at potentially even twice that, right? Like all the
Yeah,
commitments. So you have this huge amount of debt. You have the purchasing power decreasing. Gas today is like 4.50 a gallon in California. I remember it was $1 a gallon in high school.
right.
The cost of rent is way higher than what I remember when I was in school. Cost of housing, the cost of copper, the cost of food, the cost of energy, everything, right? And in order for those to actually become stable, like in order for our dollar to have to maintain its purchasing power, they have to have very different conversations in Congress than what they're having right now. They're not talking about cutting the spending. They're not talking about strengthening the dollar, strengthening poor people and middle classes purchasing power. They're talking about spending more. So we can't change that, but I think what that's going to translate to is more inflation, more headwinds, and more demand for affordable housing.
Right, and to touch on that too, the interesting thing is that traditionally, you have the Fed, who's not really the federal government, right? It's a quasi entity, federal entity, but you have them supposedly working in tandem with what Congress and the U.S. government is doing, trying to solve the same problem. Well, right now you mentioned, Congress, they're doing all of this spending, mass spending. Well, what does that do? It creates inflation, and then you have the Fed trying to do all this tightening and do everything to stave off inflation. So they're doing things that are opposite of what they're battling each other essentially.
Right.
Instead of trying to figure out the same problem, they're pulling opposite levers. Um, and so it's just creating more chaos because there's not we're one thing that we do sends the economy one direction, and then the Fed does something and that sends it in a different direction.
Yeah. Yeah, and even and again, agree with everything you just said. Looking at a macro, not just macro U.S. but macroeconomic, like globally, if you look at economies like Venezuela and Iran and Weimar Republic Germany, and Zimbabwe, like all those governments did the exact same thing, right? They just kept printing money, and the purchasing power just tanks. And the listeners might have seen the old black and white picture from the Weimar Republic of a bunch of kids that are holding onto a wheelbarrow of money, right? And they're um, it's like a huge amount. I can't even buy like an apple. So
That can't happen here though, Sep. This is the United States.
right. Team America. Fuck yeah. Oh, excuse me.
Yeah.
You bleep that out. But I mean,
Uh,
unfortunately, like I mean, minimum wage in 1960s, right? $1.50 an hour. Minimum wage when I was working at a cafeteria in high school, I was making $5 an hour. We're working
yeah.
at Best Buy. Yeah, I was making $7 an hour. Then there was a push for $15 an hour. Then there's a push for 20, 25. It's like that's not the solution. They're making 20 times nominally more wages than decades ago, but the purchasing power is decreasing, right? Like you
Right.
can't buy as much with it. And I know it's kind of doom and gloom. So some people can look at that and be like, well, I'm just going to stay on the sidelines. But even if you do that, inflation is eating away your purchasing power. So there's still
Right.
opportunities. If you can still borrow money at a single digit, and if they say CPI is 8%, well, if you're the Austrian school, you think it's even higher, like maybe twice that. So if you think real inflation is 15%, and if you can borrow 8% money or 7% money, how much of that 7% money would you borrow to put into whatever deals,
Right. As
commercial
much as you
or
can is the
yeah,
answer, right? Yeah, absolutely. Yeah. Yeah. And then kind of what I touched on earlier, which is that sure, there could be some market correct, and we've seen that in some markets where prices have pulled back since last spring when they were at their highs, right? But if you believe that we're going to continue to see high levels of inflation long term, asset prices are going to go up.
right,
So just waiting for the bottom, but by the time you know it's the bottom, it's already started going back up again. That's the only way to know.
right. And also focusing on cash flow, like what Kiyosaki talks about, right?
Yes,
Like if you keep that into the equation, then let's say if prices don't go up and they flatten and they even go down, as long as you can cover the mortgage and still make profit every month, then you should be fine.
absolutely. Yep. And that's what I was saying. That price is only the one thing. And it really only matters if your plan is in the short term to sell. If it's long term, it's to, sure. Yeah. If you bought it now and in 6 months it was worth 10%, are you going to wish you would have bought it for 10% less?
Right,
Well, yeah, of course. Human nature, you want to get it for as little as you can. But what if it goes up, or what if it stays this? I mean, or what if it's? I mean, there's so many benefits to other benefits, like you mentioned, the cash flow. You're someone else is paying it down for your amortization, right? If you're using leverage, which you should,
right,
in my opinion. So you can't just get so blinded by price. And people do the same thing with interest rates, right? It's like, well, I could have got a 3% interest rate last year, and so I'm not going to buy now. Well, you're not and they don't even look any closer than that. They just, well, it's now 6 or 7%, 8%. I'm not going to buy just because I could have got it for 3%. And people were doing that for years, right? When
yeah,
it was like, well, I could have bought that property for 200,000 5 years ago, and now it's 400,000. Well, you didn't. Okay, so
right,
buy it now,
yeah.
and don't regret it 10 years from now.
Yeah, and I think there's also two things, and you made a great point on with that example. There's two things they forget. One is what if interest rates don't go back to 3%? I mean, again, like
Which I don't think they will.
right. I think that was artificially low. I mean, close to zero for way too long. And two, expecting the house to go back down, it could. I mean, there's no guarantee that the houses can go up in value, but for let's say if a house was $400,000 today and they could have bought it for $200,000 before, or even $100,000 before, right? Can they rebuild the same house for a cheaper price going forward in the future compared to before? Like, is our wages getting, higher or lower? Is energy getting higher or lower? Is the cost of insurance higher or lower? Property taxes higher or lower? Lumber,
Great point.
everything, like all the commodities that go into that too. There's people in other countries that need that too. Our Canadian neighbors need it. Our, Chinese investors will need it over there. Europeans, like, so I think it's kind of unrealistic to think that you can actually build it for cheaper than before.
Right.
Just good to find a way
Right.
to.
And although
Uh-huh.
yeah, and that's a good, yeah, there's almost like a new floor that you have to think of. Well, you could have got it for this 5 or 10 years ago or whatever, but well, yeah, but building costs and labor costs, and all that stuff and materials, all of that is more expensive. So the floor is lower. Now, granted, we have seen times where, and there still are opportunities, where you can get stuff below replacement cost, so it's not necessarily a floor.
Right.
But it is something to consider that, yeah, okay, it probably costs twice as much to build it now than it used to,
Hmm.
and not that long ago even. So
Right. Yeah, actually, just one quick example. One of the houses we bought recently, $30,000, but it needs a lot of work, so it's not turnkey. So probably have to put even way more than that than what it's worth, maybe 50,000, right? But that thing will rent for about $1,000 per month. And if you look at what it cost to build that house back in like 1912, 1913 when it was made, it could be built for less than $1,000. That's with profit. So that doesn't count the land, but
wow,
yeah. So that's how far inflation has gone. So if anyone's
yeah,
interested, you can Google the Sears housing price catalog, like, and they have these old like advertisements where Sears, this old retail company, used to be able to sell houses and just deliver them on site like that, almost like a mobile home. But I mean, if you could,
crazy.
yeah,
Yes, house kits. Yep,
right,
yep, that's crazy. Um, Well, yeah, I mean, overall, I mean, pessimistic on the economy, but there's opportunity, right? There's
yeah,
always opportunity if you know where to look. So um, don't stop looking. Just know where to look and get educated and connect with the right people.
right,
So you're still buying.
yeah, still buying. Yeah, if anything, I think there's just going to be it's a better time. It's a better time when there's pessimism and you see buyers pulling out. And you don't have to worry about getting into bidding wars. But the main thing is just making sure that
Right.
there's demand for the product, right? Like we wouldn't want to be buying if we didn't think that we can put a tenant in there, or if there wasn't a lender to help us out on the takeout, or just the overall economy of it. But if any of that does changes, then the price has got to come down. So
Right, right. Yeah, don't just collect properties just because you can collect properties. It might not be the right property to collect, right? I know a guy, this was years and years ago, and he bought a whole bunch in Detroit when the Detroit market crashed. And it was like he had a whole bunch of properties, but they were all liabilities. They weren't assets. They
right,
weren't they weren't doing anything for him. So you still got to buy in good location, like locations that fit your model, and that like you said, you can find a tenant. If you needed to sell it, you could sell it, and that it's a good asset for what you're looking for. Yep.
right.
So so you've been through a lot. Obviously, you've had a lot of experience. What you've already shared, kind of one of your. I don't know if it was a mistake because you got through. You was more challenges. But what's your like one key takeaway, or maybe two if you have them, um, for like the biggest tip that you can give someone for success in this business as a real estate investor?
Yeah, there's a great book by John C. Maxwell called Failing Forward, and I was part of a mastermind years ago, and this successful real estate investor friend does student housing. He's very good at student housing. He's one of the biggest providers at USC. He had recommended it, and I love that book. Another good book complementary to that is The Obstacle is the Way by Ryan Holiday, and Tim Ferriss is a big fan of that. I like those two books because it changed my mindset, and it helped me evolve from thinking that mistakes are a bad thing, that everything's got to be perfect. Because in school we're taught, like Kiyosaki talks about, like you can't make mistakes, you got to get it right, you got to be A's, right? But the lessons are in the mistakes. Now you want to make catastrophic mistakes, like, but you hear a lot of adults say, "Oh, the stuff I did when I was a kid, I wouldn't do that now." It's like that's part of life, right? And it's the same thing with investing. So as those horror stories happened, and there's still horror stories that happen today too, but we're able to control it with the experience and with the teams that we have. I along the years, like, just basically created a manual and would put those horror stories into the manual. So when I lost money in a project, when I would tell a contractor to do something and they wouldn't do it, it's not something you can't just rely on the email or a phone call and expect it to be done. I basically made a visual guide, pictures and examples of what not to do, what to do. So that way, anyone, if it's that contractor, the next contractor, or that property manager, the next property manager, they can go and reference it. And that's kind of like treating the investing, the repositioning that we do in our business as a virtual factory. And it's similar with factories. Like for any product, they have a procedures, they have a guide as far as how to take whatever it is, like the raw product, into making something desirable for the market. So I think getting into that mindset, like, uh, don't run away from your mistakes. Like look for, or don't let them stop you, but just consider those as, hey, there's a stepping stones, and maybe there's an opportunity, maybe there's a business out of this. Because a lot of people are just too afraid to even make mistakes, and I'm naturally wired like that. They don't want to start a business, they don't want to invest, they want to wait for everything to be perfect, right? But
Yeah.
you got to be a little crazy to be an entrepreneur, and crazy is like being adventurous and being okay with making those mistakes and learning from them.
Yeah, and I think that's the big key there. That at the end is not being afraid to make the mistake, number one, but then actually taking the lesson from it and documenting. Okay, what can I do differently to not make this mistake again, and to have better systems and processes and all that stuff. Because not being afraid to fail is one thing, but learning the lessons is a completely different thing.
Right.
Yep. So awesome. Well, I appreciate you being on the show, Seb. I hope everybody has learned a lot, got inspired. Again, your story about the challenges you ran into with that building and all the other things, just kind of figuring out how to get through it. That's where we're all, you look at someone and their success, and it's really easy to just say, wow, look at them. They're different than I am. I could never do that. But we all start somewhere. We all start not owning any real estate, right? Uh, so, well, unless you like inherited a bunch, right? Okay, but for the most part, we all start without that, and so we're learning along the way, right? So don't be intimidated by someone else's success. Use that as a way to say, hey, look at where they're at. I can get there too because they started out, probably similar to what I am. And on that same note, most of the people that are successful, I know you are very willing to share. I'm very willing to share. Many people that are successful, because you have to have that abundance mindset to begin with, usually, to be successful. And so very willing to share. So don't be afraid to reach out or ask questions. Most of the time you're going to get the response that's they're willing to help you. They're not going to do it for you. You got to go out and do it for yourself, but they're going to help you.
Right. Yeah.
So on that note, I'm assuming you're okay if people reach out to you just to connect. Obviously, you take on. I don't know your investor profile. We didn't talk about that, but I know you take on some passive investors for some of your investing. Obviously, we talked about the affordable housing that you're in. So if you're passionate about that, if you want to talk to Sep about that, or just reach out and connect with an awesome guy, Sep, what's the best way to do that?
Thank you, Ben. I appreciate that. Well, my website, it's becominvest.com, and I'm pretty active on LinkedIn and social media. You can just Google my name, and then the email is info@becominvest.com. So happy to help out. Work with a lot of accredited investors and passive investors, and definitely have a heart for seeing other entrepreneurs embark on the affordable housing mission as well. So love seeing that. Love to see more of that.
Awesome. Very cool. Well, thanks again for being on the show. I will make sure people have the ability to connect with you. I'll tag you on social media and all that. So thanks again for being here. It's been a lot of fun.
Thank you, Ben. Yeah, pleasure to be here.